It's Josh Young with Bison Interests, and we're sharing our Unbridling Journey Energy's Full Potential Q3 2024 update. Please pay close attention to this disclaimer. This is not an offer, solicitation, or recommendation. Past performance may not be indicative. Just a little about Bison. We own a little over 5% of Journey Energy stock. We've been investing in publicly traded oil and gas companies as Bison for the past decade, and we've materially outperformed various benchmarks, including the small cap energy index, which we think is sort of most similar to what we do at Bison. And the goal of sharing this is to display a degree of expertise and understanding in the sector. I was actually chairman of the board of a small publicly traded company that we owned in Bison from the 2017 to 2018 period. We sold that at a profit at a time where similar companies traded down materially. So we're going to go through some additional thoughts on Journey. Journey stock is down 46% since the end of Q2, which was the financial period that we addressed in our first evaluation and discussion. And this leaves the company both more undervalued, but also raises additional concerns. In terms of Journey's underlying value, with the stock price recently at $1.73, PDP value is substantially higher. The proved and probable, as of again their last reserve report, was substantially higher. We see a lot of potential upside here, and obviously the market is very disconnected from that potential upside. We've also seen natural gas prices continue to rebound, with local realized pricing up materially. And we've seen outperformance in the Duvernay, so we've upped our estimate of potential value based on Duvernay wells coming in roughly twice as good as in Journey's presentation, and with still a lot of potential value on the power generation side as well. So, like I mentioned, Journey's Duvernay exposure is likely of higher value currently after successful wells this past season drilled by Paramount to the south, Baytex to the north, and Spartan nearby and on Journey's land, with wells coming in nearly 2 times Journey's internal initial production rate expectations that were shared in recent investor presentations. So very good results, which is excellent, and that justifies our increase in estimate of potential development value using Journey's NPV numbers and then increasing them by a percentage to get to a higher number that we think is more consistent with the recent higher initial production rates, which in the area have been correlated with higher overall production rates over longer periods of time. Obviously, there's a lot of risk and uncertainty around this, and there's no guarantees that higher initial production rates will translate to higher overall production rates, even though in this area so far that's been the case. Like I mentioned, natural gas prices in the area have surged in Q3 and subsequently. And so like we saw in November, which obviously is after Q3, we saw AECO natural gas prices go from a little over 50 cents an MCF up to a little over $2 an MCF, which is a fantastic recovery. They've subsequently fallen very slightly, but are still close to $2 an MCF. And obviously that's very material to a producer like Journey that has high operating costs and low margins and produces a significant amount of gas. So this is a very good development that increases the cash flow generation from these assets and helps sort of reduce liquidity constraints and financial burdens on the company to some extent. So why has Journey stock continued to decline? We've observed missed guidance, high operating expenses, delayed power projects, limited shareholder returns, and incentive bonuses awarded despite that underperformance. So we'll go through that. First on production guidance versus Q3 results. There was yet another miss on production results and an enormous miss on actual generated cash flow versus projected projected numbers. And that cash flow number, it looks like, is on an annualized basis. Journey's power generation continues to be delayed. The cost overruns are enormous, and there's more money, it looks like, that's been spent on these projects than was originally guided to in terms of getting them online and on production, and yet they are not online or production. There's no power gen revenue from these two large projects that the company spent $36 million of capital on to date. It looks like there's additional capital that will need to be spent before they're brought on. And then there's additional questions on communication where it appears there's an inconsistency between what Journey is guiding to in terms of the start date, and with some blame, it looks like, on the ASO. But when you look at ASO, there is a start date that they've publicly provided for Journey's power generation asset that they're addressing, and it looks like it was moved from December of 2024 to June of 2026, so inconsistent with what was in Journey's press release in November. There was a normal course issuer bid announced, which is odd to have that announced for a liquidity situation of the sort that Journey's is in, and there has been no activity on that normal course issuer bid. So there's been no shareholder returns. However, there has been substantial activity from a award of shares through restricted stock units to management and the board. And one thing that's noteworthy is this is actually after we met with the board and shared our concerns with the chairman. So there does seem to be this sort of knowing inconsistency between the very poor performance of Journey's stock as well as operations versus their incentive compensation. It sort of belies the term incentive because this is being awarded, a huge number of shares awarded despite the stock being down materially and despite missing on guidance and across a number of different variables. So digging into that miss, one of the factors that Journey cited for higher operating costs was higher power prices, and we note that higher power prices likely did elevate operating costs for Journey through 2022, but they've fallen a lot from 2022 to 2024, and yet operating costs have remained elevated. So we wonder where that cost is going, where that money is going, because it does not appear to be going to the place that the company cited as the driver of that operating cost. Additionally, in our meeting with the chairman, he cited the Medicine Hat asset that Journey acquired in 2022 as a driver of higher operating costs for Journey, and it actually is not the highest driver of operating costs for the company. This raises all kinds of questions and concerns. Similarly, on the other asset that was acquired from Enerplus in 2022, along with that Medicine Hat, we raised questions. There seems to be an inconsistency. Either there was a problem with due diligence, or there's a problem with how maintenance capex has been deployed and how the asset's been maintained, because there's a real inconsistency in the results versus what was forecast at the time of the acquisition. So one or the other of those seems to very likely be true, and that is obviously concerning and contributing to severely elevated operating expenses, which has compressed cash flow at the company, inconsistent with public and private statements that they're making about those operating cash flows. The CEO of the company continues to make public statements that that are unusual, and in this case, a statement about a Black Friday sale on the stock, and subsequent to that statement, the stock is down materially more. So that's it for now. Thank you for your time. We appreciate it. Again, this is not an offer, solicitation, recommendation, anything of that sort. We appreciate the feedback that we got after sharing the first one of these. We may share more. There's lots to unpack here. It's been really helpful to get different perspectives on this after what we shared, and we'll continue to do more work on this. And I think I'll highlight that we did actually acquire more shares after sharing that first update. We acquired shares prior to it. We've acquired shares since then. We own stock in it. We're not recommending it. We're not soliciting any money or anything like that, or votes or anything like that. We're just sharing our perspective as we have on this company a number of different times in the past. And with the shift in operating performance and the shift in guidance and the promotion of the company inconsistent with what we're observing from a factual perspective, we thought it was beneficial to share some of that. So thank you again for all the feedback. Look forward to more and hope you all have happy holidays. Thank you.